Welcome to the Money Talks for Beginners podcast. My name is Frankie Ho, a money nerd. Each week you'll hear me talk about different ways to use money more effectively in your daily life to become a smarter finance person. Thanks for spending your time with me today. Now let's talk about money. Welcome back to the 14th episode of Money Talks for Beginners. Today we are going to talk about what are traders and what are investors, and what are the key differences between traders and investors. Of course, we all know there are major differences between traders and investors, so we're going to talk about what are the different strategies that both traders and investors use, the rules that they follow, the time horizons for their investments or their securities that they hold, and other stuff too. Of course, I'm also going to tell you my experience when I was trying to be a trader probably a couple of years ago, before I got engaged and bought a place with my fiance. And now I'm trying to be an investor for long term because it makes more sense for me. I'm going to tell you my experience for that too. So first of all, let us talk about what are traders and what are they mostly into. Traders are like wholesalers or retailers where they buy and then they sell the products to make a profit, either by buying the products right away and then selling it out themselves later on to make a profit, or the traders can borrow the product at a certain price from someone, then sell it to another person or a business, and then buy it back the same amount later on to give back to the person they originally borrowed the products from. This strategy is called short selling, where they borrow, hopefully they profit the money in between the difference while the price drops. And just in case you guys are a bit slow when I'm referring to products, it means securities, or for the traders, it could be stocks, commodities, options, forex, and nowadays even cryptocurrencies are things that are, I guess, considered securities that traders will either outright buy it or they'll short sell it. Short selling, usually, in my opinion, it's a bit harder to make money on, because overall, in the long term wise, most securities, as long as the company makes sense, tends to be more profitable. But traders have their ways of doing it. Traders usually look at a shorter time horizon, maybe like less than 1 year. Usually they might look at a daily, weekly, quarterly, monthly. Rarely goes to yearly. And so its timing is very important for most traders, and time is usually the enemy of a trader, because the shorter the time period, the harder it is to trade, especially if you're a day trader. You're trying to make money every day. So as each hour goes by and you haven't made money or you lost money, it's going against you, right? So it doesn't make a lot of sense. But of course, there's also a lot of traders out there that makes a lot of money too, of course. So traders don't really concern themselves too much about the valuations, the type of business, or how does a business actually make money, because they're there for the short term. However, there are traders that will consider the macroeconomics, like what is the current news, industry and global trends, inflation, interest rates, and unemployment rate for a country, to help them determine what or when is a good time to buy and sell the security. For example, foreign exchange. For example, a foreign exchange trader might decide to buy more US dollars against the Chinese yuan when the U.S. president at that time, Donald Trump, decided to impose tariffs or more tariffs on China, making the trade worse, causing both U.S. dollars and the Chinese yuan currency, external, because there's internal Chinese yuan too, but that's a different story, to go down. But overall, the U.S. dollars would most likely recover faster in comparison to Chinese yuan, because at that time the U.S. economy has a super low unemployment rate, strong economic data, lots of money moving around in US dollars, and because Trump also at that time decided to cut the corporation rate, tax rate, then a lot of money also inflow back into the US economy, which helped the US economy improve economically. So compared to the Chinese economy at that time, they have their own issues. Obviously, the low US dollars reserve, there's a lot of capital outflows, and they have a bit more high unemployment rate compared to US dollars. the U.S. economy, which is why the U.S. dollars in comparing to the Chinese yuan would recover faster. So some forex traders or foreign exchange traders might be like, okay, since this news came out, I am going to buy more US dollars against the Chinese yuan, hoping that it will recover faster. That they may take that as a signal. So of course they will consider the macroeconomics of it. But a lot of traders usually just rely on chart reading. So typically most traders are much better at reading charts than most typical investors, because that's their job. They need to make sure time is on their side as much as possible, or try to give themselves as much time as possible to have a competitive edge against other traders that are trying to make money obviously at the same time, right? So of course the macroeconomics is not the main thing, but forex traders may tend to look at it a bit more. As for the two most common traders, the stock and option traders, they will still look at the macroeconomics area that will affect the stock and the options, but not as much as the forex traders. Most traders can value a company, but they're not necessarily good at it or even really care about it, because most traders only care about the security price in order to buy and sell to make a quick profit as quickly as possible, because they're only really holding that security for a very short period of time. So they don't really care about the valuation or what's the fair value or the potential market value of the security, because they're not looking to hold it for a long term. They're just thinking of maybe holding it for like a day or a week, depending on what type of traders they are. There are really four main types of traders out there. There is the day traders, which is of course very the most popular or the most well-known one, where the day trader essentially buy and sell securities on a daily basis to make money. Swing traders is pretty much from one position to another, from one trend to another trend on a short time period, usually on a weekly or a monthly basis, sometimes even daily, depending on how fast the swing is. It could be like, oh, I want to short, so you're going from the stock going from bullish to bearish, and then that's one swing, and then when that's done, they might attempt to go from the low again back to the high, so that's a bullish swing again. So then, depending on whenever that happens, they might be changing position more often or less often, depending on how fast the trend changed on the chart. Well, mostly short-term charts, but yeah. There's the position traders, and there's the scalp traders. The hardest one, I think, is probably the scalp traders, because they're the ones that literally try to make like very small amount of money every minute and then they just keep, they have a lot of trading volume. And in my opinion, the more trading transaction you have, the more likelihood or more probability of you making mistakes, and mistakes in the investment world means losing money. And so that's why I think the scalp traders is probably the hardest one to do, followed by day traders, and then the swing traders and position traders tend to be a bit more lenient on you, because they have a bit more longer time horizon. Well, as a trader, longer time horizon means maybe just on a monthly or quarterly basis. That's the longest I think most traders would consider doing. Day traders, of course, is on a daily basis. We are going to, of course, talk more about the different types of traders later on. Just to give you, right now, just giving you some ideas. What are the four main types of traders that are out there? Most traders, as I mentioned before, just focus on the technical aspect or the technical analysis of a security. So, of course, the hardest part of becoming a trader, when I was trying to be a trader in my experience, is the emotional stress that comes with it and the impatience that comes with it. Because for me at that time was, when a signal or some sort of position that doesn't come for a while, but you want to try to make money, once in a while I might try to attempt to kind of just force entry or force my way to buy that security. For example, I might be like, I use like a MACD, and I use RSI, and I use, of course, the moving average on a daily chart, or at most a weekly chart, looking at